Robschild, no investment advice. Welcome to the show where we view financial markets using Ben Graham's investment philosophy, macro technicals, and crystal ball gazing. Today is Friday, November 1st, 2024. Today's episode, the unemployment came in flat across the board today. The last rating of this was 4.1%. Expected 4.1. It came out at 4.1, and the employment number itself came out at 12,000, but quite a huge amount lower than the expected amount of only 110,000, with the last being 223,000. But, don't worry, folks. It was because of the hurricane. That's why. Are you joking, mass media? Admittedly, the employment, we can go flat and then keep going higher. It's possible, but for where the yield curve is and everything, it seems to me that this could be it. This could really actually be it as far as the recession beginning now, basically. It's been a long time since we've seen a number that low, that many jobs added for the month. Only 12,000. Very low number. I would have expected to see the Fed funds futures show more cuts sooner and the S&P 500 going down, and we didn't see any of that today. The market went up a little bit. Granted, pattern wise, it still looks pretty bearish in general, but we'll get there in a minute when we go through the charts. One thing changed today in the daily reminders: the S&P 500 PE ratio dropping now to 29, still a very high, historically high number. The KP ratio still being going down slightly, but still at historic, danger levels. But outside of those two things, nothing's changed in the daily reminders. Watch Monday's show if you want to see me walk through these. The crystal ball reading does remain bear market very soon. I'm going to change this to imminent now. Imminent. I think it's coming sooner than later. How do we spell it? There we go. And I also believe the Fed won't cut fast enough to save the economy. Before we get to the charts, thank you for watching, and thank you for all of the support. Starting with the S&P 500, obviously, if you just looked at the number today and you saw, markets went, up by like 1% or something, you'd be like, maybe things are honky-dory. But, if you open up the chart, it becomes extremely evident that today was not very bullish looking. This is as much as an inside candle can possibly get, with a high and close being tiny inside of this yesterday's very big red candle, suggesting that the more likely scenario for the S&P 500 is continue to break down here. I probably should have included this in the headlines of today. The Treasury yield curve, the 3-month is now below the 20-year today for the first time. So this has to do with the fact that longer rates have been going up. And like I've been saying on the show, every day that passes, we're getting closer to those coming cuts and the following cuts. So the 3-month is, only at 4.6 now. So to me, it seems like it's catching up to the 10-year pretty quickly at this point. All of a sudden today, actually. I found it a little strange for DXY, the dollar, to pop to the upside today, with the S&P 500 also going up. That doesn't really make sense. If the dollar's going stronger, stock valuations should really be going down. And also this green candle pretty much engulfs the past 4 days, suggesting that the dollar may move higher here. The VIX, the fear gauge option contracts gauge, the price of option contracts, fell today, but within yesterday's green candle, suggesting that this looks like it wants to continue higher from an already very elevated state. This is a big warning sign that we are expected to see high volatility coming still. I noted how verified investing, they said it was on the 29th, they got to their target and bought TLT They are now sitting on a loss with the long end of the yield curve rising today. The 10-year note making a new high at 4.36%. As I had said before, this purple line represents a long trend line. I can show it. It is important. That goes all the way back to the top of 2021 and then touches the neckline of this Head and Shoulders top. Again, we haven't actually gotten there yet. And so the way that I'm charting this is I'm sort of expecting at this point to perhaps get in the 10-year up to the 4.41 percent range. Again, with a chart like this, because it's so long term, you might even want to wait to look at it on a weekly standpoint, like a weekly bar chart, since it's like years long. And then you would want to see also a confirmation. If yields really are going higher and higher and higher on the long end, I would want to see that. I would want to see a close above that trend line and then another close above that candle on a weekly basis, actually. I'm pretty much out of cash though myself. I couldn't help myself getting more exposure to long duration treasury bonds. I think I'm got to be like 54% in there now. I'm just loading up on TMF right now. It's a triple leveraged version, I believe, of TLT basically. Looking at this chart makes me think, it's possible I should have waited a little bit longer to get to that 4.4 mark, but whatever. Well, we're within a range that I'm comfortable with. Again, I'm not like a day trader. I'm like more of an investor. And again, I believe that TLT is a good place to be, not because of the chart pattern, but because of the fact that bond yields are so high compared to the valuation of stocks. And, all we need is reversion back to a normal state of valuation between bonds and stocks for things to make sense. And when that occurs, but bonds will rise in price, in my strong estimation. TLT itself, however, making new recent lows, getting to $90.84 right now. Like I'm saying, it looks like it may drop a little bit further here. I'm not sure, and I'm not worried about it at the moment, especially with that 12,000 employment number. It's like, I'm surprised TLT went down at all. I'm surprised we didn't go the absolute opposite way. To be perfectly honest, I really don't understand the run from Treasury bonds today with the long yields going up. I mean, maybe the market was expecting a higher unemployment number. Again, we're flat at 4.1. And so now we've been flat for a while now. Now are we going to start ticking back down and really the economy is okay while the Fed's cutting? Okay, well then, then it makes sense for longer rates to go up and obviously for the value of TLT to go down. Again, I'm not super worried about it, largely because of that divergence between the values of stocks and bonds right now. The lower this goes, the more excited I'll be about buying more, actually, as I can sell some of my super speculative positions. Like I said, I was almost out of cash. It's because I'm holding a lot of really speculative stuff right now. I can, once I dump that stuff, just put it all into leveraged version of TLT. One of those speculations I talked about yesterday being short on semiconductors, and we'll bring that up at the end of the show. One of my other speculative positions, if you've been watching the show, I have puts on HYG. Those obviously increased in their value today with a pretty large drop in HYG. This is largely on the back of the 5-year note going higher here, but also that credit spreads seem to be spreading a little bit here finally. So like I'm saying, like the Mr. Market's just waking up a little bit here. The way I invest is I look for stuff that doesn't make sense, stuff that seems unusually cheap, unusually expensive, and trying to take advantage of that. And that's pretty much it. It's all based on Benjamin Graham's ideas. Bitcoin today dropped 1.8%. It's been a pretty decent leading indicator of the S&P 500. And so for the S&P 500 to go bullish today and Bitcoin to go to the downside, a lot of the times the S&P ends up following Bitcoin at this point. And so it's interesting to see Bitcoin falling off here. I mean, again, from like a trend line status, maybe we're going to get back down to the scene of the crime where we broke out before going higher. I don't really know, but it's interesting to watch and important to pay attention to. Again, one of my, I guess it's my biggest speculative position right now, short on SMH. I have SOXS. This is the SMH itself, the ETF that holds semiconductors. Again, trees grow tall, they don't grow forever, and I think that this market has reached its top for a long time. Actually, we had this rising wedge. We broke out of it yesterday majorly to the downside, and just like in the S&P 500, this is nothing more than an inside day today, suggesting that it's very likely for this to continue showing much more weakness. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.